morning, everyone. Today is Friday, August 12th. I'm Marv Eisen of Time and Scholar. And unlike most days where I start my morning video with the morning economic report, the news, and then going into the S&P and E-mini trading, I'm going to go straight to E-mini trading. And I'm going to use yesterday's chart as an example of how I trade. Now, yesterday morning at 8:30, there was a report issued of the Producer Price Index, the PPI, that came out, and it was generally pretty good, better than the forecast. So it drove the market up, and we see that over here at 8:30 yesterday. This was August 11th. And the market opened over here. This is the 9:30 time slot that I have, where I have my cursor. And you see my trading zone that I draw out every day, and the previous day's close over here, represented by the horizontal line. Now, most people trade based on what they're taught or what they know, or the seat of the pants. I think seat of the pants for the most part. I trade based on, trade setups. Trade setups are a key. And I use only 6 trade setups: GSTTMC, gap, support and resistance, trend, time and price, momentum, and candlestick. But here's the problem with trade setups. With few exceptions, trade setups are difficult to see at the time they are forming, at the time they're setting up. Sure, hindsight is 20/20, and it's easy to look at yesterday's chart or a previous chart and see where the trade setups were taking place in hindsight. But in real time, it's quite another story. Nevertheless, that's what the trading gods give us, trade setups, and that's what most traders use. I use them. But again, hard to know when you're actually looking at a trade setup and when prices are just moving. So as I said, I have 6 trade setups. Not all easy to see, But I want to give you an example of how I trade, because in addition to trade setups, I know a few things that I apply to my daily trading and to how I teach trading. First of all, I mark my chart with things that I know. And what do I know? Well, I know where the previous day's close was, so I always mark that on my chart. Why is that important, Mark? We'll get to that in a minute. And I also know the trading zone calculation based on Taylor's trading technique. A difficult calculation. You can buy Taylor's trading technique in Amazon. You can read the book. If you can discern what the calculations are, there's 12 calculations that go into them, into discerning what the trading zone numbers are. You can use this information yourself. But the trading zone is based on a numerical calculation. But that numerical calculation is based on real numbers, where the market has been. If you want to know where the market is going, you've got to know where the market has been. So I know many of you watching this video will say, Mark, that doesn't make sense. Where the market has been is already, old news. It's old news. Well, not quite, because the market has a rhyme. It has a rhythm, and that rhyme and rhythm can be put into numbers. And I use those numbers just as George Taylor did, and so many professional traders do. I use those numbers to estimate where prices may trade on a given day. All right, numbers. So I know my trade setups, my 6 trade setups. I know the previous day's close, and I know the trading zone based on nothing but numbers. Okay, so yesterday, August 11th, at 8:30, the market opened right up over here, 42.35, and then started going up. Now, here was my trading zone. Now, as I said, my trading zone indicates to me where prices should trade. So prices were not only not trading in my trading zone, but they were moving away from it. And they were moving away from it in a upward, I'm not going to call it a trend, because to me this is not a trade setup. Prices are going up, but it's not a trend. There's just too much. There's just too much gyration in the price. There's 4 points between each horizontal line on this chart, so you get an idea of the amount of movement in these candles. And these are 3-minute candles. So in a 3-minute candle, let's say we've got about 6 to 8 points in every 3-minute candle, and it's moving away from not only my trading zone but the previous day's close. Now, as I said, I would get to why I use the previous day's close. Well, the previous day's close is an area of price where buyers and sellers, and I'm talking about big buyers and sellers, I'm not talking about you and me, where buyers and sellers generally agree value exists. So that's an area where, at the end of the day, buyers and sellers agree there's value, right? Because the value is the underlying factor behind buying stocks and holding on to them. Value that, you can trade, but what the stock market is all about value. I had an uncle, my Uncle Phil, and I talk about him in my trading course. Great businessman, and he always bought value. Does the name Warren Buffett ring a bell? Only buys value. Value and cash flow, by the way. But nevertheless, as traders, we want to know what the big boys know. And what the big boys know is, at the end of the day, there's a level at which they agree value exists. So, previous day's close. And why it's important is that prices will gravitate back to those previous day's close, especially if they open above or below the previous day's close. And they opened over here yesterday, well above the previous day's close. This was 42.10, previous day's close, and it opened around 42.38 and moved away. So I'm watching and I'm waiting, and here's my trading zone, and prices in relation to the trading zone mean nothing to me, don't help me. So I'm watching. But what happens here at around 10:15? I see a trade setup. You see this almost a shooting star reverse hammer? That is a trade setup that is easy to spot when it forms at the time. And not only is it a trade setup that's easy to spot, but it also corresponds to a confirming indicator. My stochastics is overbought. Okay, so a reverse hammer at the end of an uptrend. It's not an uptrend. I don't call it. It was a move upward, but I don't call it a trend. Not long enough to be a trend. There's one other thing that I know. I know that the intraday high or low is generally put in within the first hour of the trading day. The intraday high or the intraday low. Okay. So now I have my trading zone. I have the previous day's close, and I have a setup. Okay. So I know that my trading zone has not only a resistance and support, okay, an upper and lower limit, but it also there's a range between that upper and lower limit. And I know usually that prices will trade within that trading range. And I like to measure it based on where the intraday high or low is. Now, my trading zone is a number. It's a calculation. So what I do when the price puts in a number and it's away from my trading zone, I use my trading zone and I transpose it up to the intraday high or low. And this is what I did yesterday. I took my trading zone, okay, and I'm going to copy it. And I'm going to move it up. I'm going to move the copy up to the intraday. I'm going to move it. I'm going to move. Okay. So here's my transposed trading zone. I'm going to change the color so it's easier to see. Okay. So here's my trading zone based on where the market is. Market intraday high was over here. Did I know it was the intraday high? At this time, I felt fairly confident this was going to be the intraday high. So I haven't made a trade. I see my setup here represented in this candlestick. Remember, GST, TMC, C stands for candlestick. This is my candlestick setup. Okay, I see, well, if the transposed trading zone is up here, marking where the range of the trading day should be, and this is the upper limit based on the intraday high, prices should trade down to the low based on the range of my trading zone. So I put in a trade, and as the day progresses, what happened? Okay, prices moved down to my transposed trading zone support down here. Okay, bounced off support. Does that tell you something? Is this technique worth knowing? Okay, so the day moved on. Prices trading around my trading zone, around the support of my trading zone. Didn't violate it. But I also know prices like to move back to equilibrium because that represents security to the big boys. And equilibrium is down here at the previous day's close. So as the day goes on, now my trade was this, okay? My trade was this down to my, it was pretty good for about 40 points. I didn't do the whole, I didn't get the whole range, but you get the picture. And then in the middle of the day, I have lunch, I do my thing, and I see in the middle of the day, in the afternoon, what happens? Prices break through my trading zone support. And where do prices want to go? Where do they want to go? They want to go to an area of stability, an area of value. They want to go to the previous day's close. The gap, close the gap. And what happened? They closed the gap. And I got this trade too. So I used my knowledge of trade setups. In this case, I only used one trade setup, the candlestick right here. And that didn't happen until 10:15. So I just did nothing. But I used this not only to base a trade and to determine where the intraday high was likely, but I used that information to transpose my trading zone and use that to take the trade down to the end of my trading zone. Now, why didn't I stay on here? I mean, it went down so far because this was my target. I use targets. The target. The market knows where it wants to go. I don't know where the market wants to go, and neither do you. Neither does anyone else. But the smart money knows where the market wants to go. The algorithms know where the market wants to go. And I can only use what I know, what my numbers tell me. And these numbers are based on 75 years, more than 75 years of experience, and based on George Taylor's technique. I don't take credit for it. I just do the numbers. And so this was my trade. But then in the afternoon, it bounced off. I don't know where it's going to go after this, but I know this was my range. This was my area to get off. Right over here, actually. Once it hits the target, I get off. And in the afternoon, I see what's going on over here. I say, prices are pretty close to the previous day's close, and they want to go there. And they did. Boom. And this was the target, and this was where you get off. You don't stay on. Well, it could overshoot a little, but this was the target. So that's how I trade. And did I reveal any secrets today? I hope so. I hope you learned something. If you want to use the trading zone, you have to be able to calculate it. Get the Taylor Trading Technique book at Amazon, or you can take my course where I show you how to calculate it yourself, or I send you the numbers every day in my subscription service at timelessdollar.com. Click on the nav bar. You'll see the link to the subscription. Not expensive. And that's it. So anyway, that's my video for today, Friday, August 12th. Thanks so much for watching. This is Marv Eisen from Timeless Dollar. Remember, when you're trading, use a lot of patience. Because patience will be rewarded. Don't just hop on every trade. I know it. Whenever you open your chart, every candle looks like a trading opportunity. It's not. Okay, so I appreciate you watching this, and I'll see you in my next video. Marv Eisen for Timeless Dollar.